Can you speak a bit more about what is an originate-to-distribute model?
So the originate-to-distribute suggests that the banks or the lender, could be a bank or a non-bank financial institution, but that institution is the lender. However, they might not use their own balance sheet to keep the asset, because indeed sometimes the risk-weighted assets lead to unprofitable flows, which is why basically the lender is focusing mainly on the servicing role, signing up, onboarding the client, funding the client, but then once the asset is on their balance sheet, they will distribute to a partner. Could be a credit insurer on the risk side, the unfunded participation of a credit insurer, could be another bank, or it could be a liquidity provider like an institutional investor that is buying the asset. However, the institutional investor will not try to service the asset. They will be in the background, in the distribution space, acting as a liquidity provider, and the lender, the bank or the non-bank originator, will continue to service the asset, will keep skin in the game, but will share the revenue of this transaction with a partner, such as those I mentioned. Now you could ask, what is the purpose of sharing revenue? The purpose is to decrease the risk-weighted assets on the balance sheet and to be able to originate more transactions. So the focus more and more with the originate and distribute is to focus on the servicing revenue rather than the pure return on equity revenue from the transaction.